Hello and welcome to Property Question Time. I'm Stephen Galpin and this is the show where you can have your property related questions answered by a team of experts. And helping me get through this today is Glenn Jacobs, MD of Next Home. Welcome, Glenn.
Thanks for having me.
And Josh Knight, MD Sales and Marketing at Glenhawk, short-term property finance experts. Welcome.
Thank you for having me.
When bridging loans have been secured to facilitate the commencement of a development, what would the lender require in terms of seeing a secure exit strategy and long-term financing of the project? In other words, what have they got to prove to you?
Ultimately, the lender just wants the exit to be realistic, stress tested and evidenced. So in the event that you're replacing the bridging finance with term debt or a development loan, typically the lender would want to see terms from that exit lender where the net loan of that refinance is sufficient to repay your loan in full. In the event there's a shortfall, the lender would want to know where that shortfall is coming from. I'll tell you what a big red flag for us is, and we see this, you'd be surprised how frequently. We ask for the exit and it's put forward as sale or refinance. And from a lender's perspective, it's like, well, we don't really understand the deal. We need to understand what the investor's primary objective is. And from a risk position, a lender will use the exit to guide the emphasis of their underwrite. If the exit is sale, the underwrite becomes more about the asset, its appeal, its liquidity. Yeah. If it's a refinance play, it becomes more about the borrower, the income, the affordability, because that...
And the uplift.
Of course.
Presumably.
And the reason there is because that is the lens through which a buy-to-let lender will review that application. Not knowing is a really poor starting point.
How competent do you find developers in general when they're putting these proposals to you? Do they say, well, I'm an experienced developer, just come on, lend me the money, or what's their reaction to this sort of stress testing?
Well, I suppose it depends really. If they are very experienced, sometimes there's a degree of frustration when questions are asked. But ultimately, a lender won't lend until they feel comfortable. And arguably the most key part of that underwrite is the exit. So really we need to understand plan A and plan B. And as I say, realistic, stress tested and evidenced.
And much better if you have got a plan B.
Yes.
I think.
What's the lender's view on why an applicant would be so vague in regards to the exit? Is it because they would pivot depending on what they get offered?
I don't think that having a plan A and plan B is a bad thing. Actually, objectively, that's a good thing. But what a lender really wants to do, particularly if it's a development, is they want to back the client's vision.
Yep.
So we want to know what is the primary goal here, and we want to get behind you. When you don't even know what your primary goal is, how hard, it's much more challenging to back them.
Yeah,
you don't understand what you're backing.
I mean, from a development point of view, you could actually hope for sort of three tranches of funding. You've got your bridging to get you going. You've got your longer term finance for the project's length of time. But also from a developer's point of view, often is the case, you build, say, 200 flats in a block. All your profits in the last 20, and it's that last 20 that you're left with. So the most difficult. Am I right?
Absolutely, that's where the deals happen.
and that is the time when your profitability often crashes because you're having to cash these out. You've got pressure from your financier to get rid of them and say, come on, you're running out of time.
Yes, and I think actually there's a big market for what we would call a development exit bridge, which allows a developer to re-gear at the point that the development hits practical completion, to take some of their money off the table to go into other developments, and gives them time to market and sell the units with less pressure.
I suppose all of these things are becoming more and more important as we're searching for volume of housing, because there's no question there's a shortage of product stock. But you've also got to balance against that the ability of people wanting to buy. Have they got the ability to buy?
Yes.
That's the big question. I mean, when I was very young, hundreds of years ago, I mean, you just bought a property and it wasn't any fuss, maybe 5% deposit you had to put down on your first time, which was no big deal. It's the sort of money you could quite easily borrow from mum and dad, without causing their pension stress, But times have changed, the investment, the loan to value position has changed tremendously, hasn't it?
It has, yeah. And look, I think for us to see a recovery, two things need to happen. We need an injection of confidence. We need investors and buyers to have an impetus to kind of re-enter the market. But then, as you say, the availability of suitable mortgage products to actually support that demand.
Yeah. If a young person were to ask me 15 years ago, 20 years ago, should I buy a property? Should I put myself out to buy? I'd say yes, do it.
Yep.
I'm not sure I'd answer the same today.
No, and I feel like there's a horses for courses situation as well. I think with the new builds, I think I personally wouldn't look to buy a residential property for myself, or even an investment property that at least hasn't got an angle on it, or development opportunities where you're already maxed out with how many houses you've put in development or how many flats you've got, or that sort of situation. You're already limiting yourself to only a pocket of the market there. And with money so expensive at the moment, it's kind of limiting the applicants you got for it.
Okay, Glenn, it's been reported that so far this year there's been a record number of financial business failures in the estate agency industry. As a small and independent agent, what would the experts suggest I do to safeguard the longevity of my business based on what they perceive as the most common causes of failure?
So the first thing I picked up on that report, which was in the news, is does that incorporate some of the self-employed business owners that there's been an explosion of since COVID almost. You've got a lot of individuals going out there and left out in the lurch almost.
It's also coincided with the collapse of the coloured brick organisation.
Absolutely. Exactly that. And so yeah, the devil's in the detail on that report. I think if you are a good established company with a good element of all aspects, I think you can navigate most markets. I was working in 2008, managed to get through that. I was working in Brexit, managed to get through that. COVID, managed to get through that. It's moving with the times and adjusting with the scenarios and situations that are at hand at the time. But I think that's might be a little bit of an embellished number because of the amount of people that have gone out there seeing a lot of the social media stars in the property world and the gurus, and you can go out and earn this and that. The amount of mistakes I've seen from people going out and purchasing properties at auction without doing any due diligence.
I think a lot of people have underestimated the loss of good corporate backing to it when you're going into these kind of businesses.
Yeah.
I mean, to work under the umbrella of a good corporate organisation is worth $1 million, isn't it?
Yeah, on a reputation basis, and a lot of people see that as there's redress and whatnot. With the self-employed model and an individual basis, you're trusting someone with your most valuable asset that may not have ever done it before or gone on a training course for a couple of months. And I know what I was like after a couple of months, and I wouldn't have trusted me with the property. So
I suppose, Josh, it's very much the same in your industry, isn't it? If you've got a good, excuse the pun, bank of lenders as a good broker or a good intermediary, then your credibility is going to be somewhat higher than somebody who's, just going around with their briefcase trying to, in a cold format, solicit business.
Yeah, I mean, look, the bridging market's interesting in that you do have a cohort of private lenders who don't actively market themselves as lenders, and they just have access to capital and are willing to deploy it extremely quickly for a price. And I think that has its place in the market.
Yeah.
And obviously, I think the bridging market over time has become more professional. There are some bank lenders that are deposit funded. There's lenders like us who are institutionally funded, but have been around for a long time, and that hopefully gives people confidence.
Yeah.
I just feel like in regards to your actual initial question, how would you safeguard sort of in this current market? I feel like a nice mixture of the old school and the new school. You can really streamline your operations on a day-to-day basis as a small industry with AI.
Yeah.
Years ago, I used to spend 2-3 hours typing up a description for a property. But if you've got a historical data pack of the property, within 10 minutes, you can write up a description.
But if you haven't, AI has.
Absolutely, exactly that.
Yeah.
And in terms of on a sales basis, I think gone are the days where you used to be able to just list a property and you'd have 20 applications the next day and whatnot. I think now, the old school side of it is bouncing people from property to property. having that agent work with you alongside you, building that rapport, getting someone in a car, going to 3, 4, 5 properties in a day, becoming that personable agent, that kind of got lost. That sort of building a relationship with an applicant wasn't necessary at one point.
Glenn, just tell me, this new breed of brokers, shall we describe them as, do they have the same access to the portals that you as an established agent would have?
They have their own portals, but not in terms of Rightmove Plus, for argument's sake. So Rightmove Plus, I earn so much out of Rightmove Plus, even though it's the most expensive by a million miles. I pay more for Rightmove Plus than I do for some negotiators. And that's crazy, but it pays for itself because you can go back to the year 2000 and have a look at properties that were marketed, withdrawn, all that. But in terms of your question on the broker side of things, no, they've only got access to their own CRM. So it's like you're at liberty of the other people within that company being able to access your applicants and how good their information and data is. So they're missing out on that side of it, yeah.
Yeah, that may in fact be quite a significant cause of the collapse of some of these people, I would think.
Yeah. I think as well as that, on a self-motivated basis, I think if you're sitting in your living room and, I don't know, your kid's off sick and whatnot, I don't think you're going to be out there as much as if you've got a 9-to-5 contracted job.
I think we all know that the self-discipline that's needed to work from home yourself is quite serious.
Absolutely.
It's really quite serious. I'm not a fan of it at all. No. Not at all. Anyway, look, there we are. That's all we've got time in this half of the show. So join me again after the break when we'll be asking Glenn and Josh more of your questions. Hello and welcome back to part 2 of Property Question Time with Glenn Jacobs and Josh Knight. Right, Josh. Oh, you're going to enjoy this one. As I'm about to apply for a property development loan, and I'm not keen to make any mistakes, what are the most common reasons that a developer's loan application is declined?
I think the most common frustration that we have certainly is where the numbers are unrealistic.
Yeah.
So usually that will form a case of where the build cost is too low, the GDV is too high, or both.
Usually both.
Yeah. And when you're looking at a development appraisal, you usually do a profit on cost analysis. And when that figure is very high, 50, 60%, you often know that something's awry. And that's a real red flag for lenders because it shows that you haven't really scrutinised your own numbers. Your build costs need adequate provision for contingency, and your GDV needs to be grounded in fact. What have similar properties of a similar size and spec sold for in the area? If it's a yield-based GDV, is the market rent realistic? Is the yield applied appropriate? So that's the first, really scrutinise your numbers. The second is where there's a disparity between the scale of the project and the experience of the investor. And inexperience on its own is not an issue, but as we've discussed already, not putting forward who your professional team is that will help you to deliver that project is a cause for concern for lenders. So I'd say nail down your numbers, build a professional team, and stress test your exit.
Okay, so in practical terms, what you're saying is make sure that your package that you present to a lender is complete. So who would you get as part of your team to actually put that package together?
Well, that's the appeal and the need for a good broker. So the broker will form part of your power team, if you like. Independent planning advice is probably a good idea if it's a scheme that requires that, or even if it's a scheme that doesn't. Planning consultant, architect, your lawyer, your contractor, sometimes even the managing agent that you'll be using at the back end post-development. All of those things will show that you've A, considered it, and B, it will give your lender comfort that they're there to deliver the project. Yeah,
I think given your opening comments about unrealistic figures, I think what you have to remember as a financier that developers are wheeler dealers. So you see, when they come into you, they know you're going to knock the figures, so they start up here.
No comment.
and expect to be brought down here, but you're not wheeler dealers.
Yeah.
So
I think you're so right. As well as that, you get the inexperienced people that don't understand a deal is not a deal. The amount of stuff I get sent that are not actually under market value, that I'm like, I don't really understand where the amount is. And if you're an inexperienced person, the thrill of getting that property is kind of the thing that blinds you almost. You're like, oh, I'm going to own this property, but it needs to stack up, doesn't it?
And there's a balance that we understand that it's a good thing to be optimistic, but it's not a good thing to attach hope value to a project.
No.
Because that's just going to be ripped away at the point of valuation anyway, and will impact the amount that you can borrow before the loan completes.
And I think also applicants also ought to remember, I mean, it's probably not so much you, but probably Glenn, you've experienced. I mean, I seem to have spent last 100 years arguing with valuers, you know, about this, that and the other. And you have to realise that these days, if you get a bad valuation because you've not been accurate with your information supply, you really are stuffed, because that information is syndicated in so many places now. That the financier, if he wants to check your figures or questions your figures, I mean, he can just press a button and have all the information he wants.
There's that, and I've also seen an increase in good property people. I'm not going to say estate agents, but good property people actually packaging a file for a surveyor going around there to basically almost do their job for them. And it's the historical comparables because they call around the estate agents anyway. They call around the amount of phone calls they get for comparables and on sold prices.
Well, I look, it's a fact of life. You know, valuers, much as we think they're not sometimes, are actually people.
Yes.
And people appreciate assistance with doing their job. And you know, I know when you used to run a team down here, if a valuer was coming, when you was coming, we'd prepare all the comparables that were applicable to the apartment or whatever it was being sold. You give him that as a file. It'd be complete, it'd be accurate, it'd be factual. And he'd be most appreciative.
You'd be amazed how many, you know, that's a really key point. I often say to borrowers, meet the valuer on the site. You'd be amazed at how many people say, "Oh, just pick up the keys and let yourself in." But you need to kind of sell the scheme and help the valuer to understand what you're trying to achieve. And look, there is a degree of subjectivity to valuations in terms of quality of finish, particularly in, let's say, the HMO market, where people will pay a premium for an ensuite. People will pay a premium for better amenities. But just leaving that up to chance is not a good idea.
I mean, it's interesting. One of the things we used to come across, especially here in Canary Wharf, and Glenn sort of alluded to this in other conversations that we've had. You've got a valuer come. He wants to work by the RICS Red Book rules, not allowed to look at what's going to happen in the future. He has to value today, as of today. But I can't tell you how many times I've heard a valuer say, yeah, but did you know there's 20,000 apartments coming on in Canary Wharf in the next 4 years? And I would say, well, so what? That's not within your RICS regulations. And he'll say, maybe not. But it's in my head.
Absolutely.
You know, and that's going to affect things.
Also, tenants affect what a surveyor's valuation would be. If you don't go down there and meet a surveyor and run through and give them background and what's going to happen in this, that, and the other, a tenant's comments is also something that's going to sway a surveyor sometimes. So, yeah, it's really important.
But it needs to be grounded in fact.
Absolutely.
You know, because your property has gold taps doesn't mean it's worth more than one that doesn't.
The amount of times I do valuations that's brought up. I've got a Versace bedspread.
Yeah.
I actually haven't, but
I'll bet you have. Okay, righto. Glenn, at this current time, London in particular is suffering from a lower rate of sales transactions and indeed price drops. What do the panel think is the main reason for this? And if at all, how quickly can the market recover? And so I just add a qualification of that. I'm not so convinced this time. It's just a natural circle of events where, you know, it rises, it falls, it rises, it falls. And we've just seen this 10 times in the last 10 years. And I just get the feeling there's something a bit different this time.
I do as well. You've got the standard sort of homeowner, residential homeowner, still stuck on prices that we was looking at maybe 2 years ago, something along those lines, before the interest rates started sort of spiralling and whatnot. That they're just stuck on, that's my price, that's where I'm going to be. The people that are selling are people that are looking at tactfully marketing their properties at an achievable level, or structuring a marketing plan, putting the property on the market for slightly less than what you're looking to achieve to get people through the door and create that buzz and that interest. You're just not going to get the views if you put the property on the market for a little bit more and expect offers less. And that's an old school way of people thinking of it. Oh, someone will offer me less anyway. It doesn't work like that anymore on a lot of properties that I deal with. And that's the old mentality. You're better off having a good couple of block viewings, creating a buzz, the psychology of having block viewings, seeing other people there. The other aspect is, yes, prices are still higher. The stamp duties relate to what the prices are. Stamp duty, really costly. Solicitors' fees have gone up as well. They're all contributing factors. You've just had the interest rates at 3.75%. That reflects on the market. Not many people can afford to buy at what they was able to buy at during COVID. I've said COVID a few times today, but that's the barrier. I've got a 1.79% rate on my residential mortgage currently, so I'm buzzing at what my room mortgage is going to look like. Yeah. And those are the things that are stagnating the market.
I think that the confidence will naturally return to an extent to the market. So once the Iran conflict concludes, swap rates will settle, mortgage rates will hopefully come down fairly swiftly thereafter, and that will give investors and buyers an improved confidence to re-enter the market. Whether we'll see a rally or not, I think I agree with you, Stephen. I don't think it will come.
No, I just, I mean, we've seen huge swings in the past, haven't we? And you see every time in the past there's been a downward number of transactions, we've seen then a shortage of properties going onto the market because people either can't afford to sell or don't want to sell at those sort of levels. It then starts to come back probably 18 months, 2 years on.
Yep.
You see this then sudden upload and there's an explosion because people are fighting for properties because there's still too many on the market. It just doesn't seem that sort of situation anymore.
No, and like you mentioned before, you would have advised 10, 15 years ago, get on the property market, get on the property market. I was saying exactly this to my wife before we purchased a couple of houses before. I'm not just going to buy for the sake of buying. No. There's no point just buying for the sake of buying. You've got to buy something that you're either going to be able to add value to or move on in a couple of years' time, unless that's your forever home. And it never was going to be so.
Well, I think that, again, is a very important point. It is that I think there's been a little bit too much mixing of the ethos of, buying your home for investment. It's not an investment. It's either your home or it's an investment. Yep. And you'll be very good at discerning between those two, and you'll make people look at that, won't you? I think.
Yeah, absolutely. And again, it's about understanding the objective and backing their ambition. There's definitely a distinction between the two.
The problem with that I was looking up the other day though is if you outright state that you're buying your residential home as an investment, you could get done for capital gains tax.
I suppose you could, yeah.
Because you've outright stated that's an investment.
And probably from your bridging lender too.
Absolutely.
If they've deemed it to be an unregulated transaction, then it becomes clear that it's not.
So don't go on social media saying you're buying your residential home as as an investment.
Well, I think on that happy note of expectation, I think I'm going to have to say that's the end. Okay, well, look, a big thank you to Glenn Jacobs and Josh Knight. Thank you both very much for coming in.
Thank you very much.
Thank you.
I'm Stephen Galpin. This has been Property Question Time. Join me again next time.